So here we go, Chapter 8, which takes a look at regulating insurance companies. All right, so we'll do 14 slides today discussing regulation of insurance, and then we'll do 13 slides on Tuesday, and we'll be done with Chapter 8. So we have a test covering 5, 6, and 7 next week. And what day do y'all want to take it? I'll take it Monday or Tuesday? Tuesday.
Tuesday works better for me.
Tuesday when?
Tuesday works better for me.
Okay. So you want to take it right after our regular class on Tuesday? Can y'all do that? Is everybody available to do that? No?
No, I can't.
When can you take it, Cassie?
I would, it honestly depends on how many, if RAs go down this weekend. And if
Okay.
I have to, because we have to pick up their desk hours.
Okay. I can open it on Proctorio for you. I just hate to use class time to take an exam because we still have so much to cover. And I don't want to use class time. So we'll plan on taking it at 4 o'clock then on Tuesday. And then I'll open it up for you on Proctorio. All right, very good.
That's chapters 5 through 7.
Pardon me?
Chapters 5 through 7.
Correct, 5 through 7. And I will allow you to bring an index card in to that test because there's some calculations so you can perform those on. No,
Is that index card 3x5 or 4x6?
4 by 6. Yeah. Okay? All right, so let's look at regulation. Not too interesting and not too complicated. So I'm spoiling you before we get into the life insurance part, which is a little bit complicated. We'll start talking about life insurance. Okay. All right, so why do we regulate insurance companies? The first goal is to make sure that these companies maintain their solvency. Why? So that they can pay claims. Why? Because they employ tons of people. Okay? Why? Because they are critical to the economy. So the regulators are focused on making sure that these companies are safely managed. Okay? So there you go. I hadn't even looked at it. Hadn't even looked at that, so I already did the second one, sentence for you. Okay, another reason why they're regulated is because consumers are not well acquainted with insurance products and the relevant issues, and so the regulators want to protect the consumer from insurance companies that might not be on the up and up. Okay? Complex contracts. I need to stop getting ahead of myself. All right. So the contracts are complex, very thick. Most people just don't. They take the word of the agent, and there are lots of great agents out there, okay? But they really don't understand. And again, I talked to a client just the other day who's got an annuity, and he doesn't know anything about the annuity. Okay, he said, this is what the agent said I should do. Sounded good to me, and I did it. Okay. Oh, I said I was going to take this. Is my voice louder or softer when I take my mask off? Or about the same? About the same? It's a lot louder when I have my mask on because it feeds back right into me. All right. Okay. Make sure that rates are reasonable for customers. And again, we talked about rates in terms of, are they too high? Are they too low? Goldilocks, those rates have to be just right. Okay? High enough for the company to make a profit and maintain market share, not too low to try to steal market share, and not too high to gouge customers who have to have it. Okay? Now, there are some insurance products that by law, as a customer, you have to have. You've got to have it. You've got to have automobile insurance. If you have a house and you owe a mortgage, you've got to have homeowners. Okay? So they know you got to have it, so they're tempted to charge you a high rate. If they all get together, they all call each other and say, hey, let's keep our rates pretty high. All these homeowners have to have homeowners insurance, or they can't get a loan without it. You know, let's not undercut each other. That's collusion. All right. So this is particularly true when there's not a lot of competition. By the way, update on my phone, AT&T just offered me 4 iPhone 12s for the same monthly rate as Sprint, and we're doing the deal on Saturday. We'll see. That's what they said. They said, "You've already been approved. Everything's on go. We'll finalize it on Saturday. We'll see." So, all right. They're regulated to make sure that insurance is available. We'll talk about what happens when when insurance is not available, what customers can do. There are options, okay? All right. So regulators look at a market. If insurance is not available, then they make sure that some option is available to customers who need it, even if the government has to jump in. All right. The history of regulation, I can't remember if it's in these notes or not, but the history of insurance companies really starts when there is shipping commerce between Europe and the New World. That's what really prompted the creation of insurance. Okay, when ships were sailing across the ocean and companies had to deal with the risk of loss, that's when the concept of insurance really came into being. And as is typically the case when, as industries are born, created, there's not a whole lot of regulation involved, and then as people become acquainted with it and you have a history and experience and you learn what you need, then your regulation grows. Okay, more and more regulation. So regulation started on a state-by-state basis because really that was the tradition of the U.S. Not a strong central government, strong state governments, states' rights, okay? So state legislatures said, hey, we're going to have to authorize these companies, these insurance companies, to start working in our states, okay? So once they started looking at charters, which are permits to operate, then they started creating state insurance commissions. A department, a commission is a body, a department that is devoted to or dedicated to regulating one industry, the insurance industry. So New Hampshire started it back before the Civil War. Then the Supreme Court stepped in and made some rulings. Okay. Paul versus Virginia. This is a case. And that's how the Supreme Court works. And if you've watched any of the hearings, it's been really a great review of how our government is set up. So laws are created and then people go to court and present a case against a law. So Paul versus the state of Virginia was a court case where Paul said, I don't agree with the law and I'm going to go to court and see if I can get a ruling on it. So you have a lower court that rules on it, then you make an appeal and it goes to the appellate court. Then the appellate court rules on it, and then you can appeal it to the Supreme Court, and the Supreme Court decides if it is a case that is appropriate for them to hear and a case that is important for them to hear. And they decide if they're going to hear the case. And that's how it gets to the Supreme Court. It doesn't get there until it's had at least two other levels. All right. So in this case, they said insurance is not interstate, which is between states. It is a state matter. Okay? So the state, each state, rather than the feds, has the right to regulate the insurance industry in their state. So this was an important precedent. A ruling was made. According to the Constitution, the states regulate insurance in their industry. And again, that's something important for us to know. What is the role of the court? Is it the role of the court to make policy? Do we want a single-payer healthcare system? Is that the role of the court? No, it is not. It is the role of the court to look at a law that the legislative body comes up with. It is our congressmen and senators that make the laws. The job of the president is to enforce the laws, implement and enforce the laws. The job of the legislature is to make the laws. The job of the president is to enforce the laws. And the job of the judiciary is to see if the laws are consistent with the Constitution. So the president, when the president is elected, he or she says, here's my platform, and I've got a bill that I'm going to hand off to some supporting legislators, and you guys look at it, and if you want, you sponsor it, but you're still sponsoring the legislation. It might be the Trump tax cuts or the Obama Affordable Care Act, but Obama has had nothing to do with getting it passed, and Trump had nothing to do with getting it passed. The legislators do that. Once the legislators do that, if no one challenges the law in court, then the president must enforce and implement that policy. But it is not the job of the court to come up with a policy. Oh, I don't like socialized medicine, therefore I'm going to strike it down. Absolutely, positively not. And people misunderstand that. It is not the job of the court to make policy. It is the job of the court to read the law and look at the Constitution and say, the Constitution allows this, or the Constitution does not. And a judge may say, I don't like socialized medicine, but that has no bearing whatsoever on their ruling. They are only looking at whether it is constitutional. But then there are judges that have a different view of how to interpret the Constitution. That is an issue. All right. Next landmark situation relating to regulating insurance, another Supreme Court case, U.S. versus Southeastern Underwriters Association. So the government took on an insurance association. Okay? So here, the court ruled that insurance that is interstate commerce, okay, when it is conducted across state lines. So when a company in one state is doing business in another state, that is interstate business. Okay? Therefore, if it is interstate, that involves more than one state, the federal government can step in and regulate. That is the job of the federal government. Typically, the federal government rules in areas where the states don't rule. We'll look at that. All right. So all of a sudden, we had a lot of confusion in the industry. Who regulates us? The feds or the states? So Congress looked at it and said, hey, we passed the laws. Let's go ahead and address this directly. Okay? And that's what happens if the Supreme Court rules that a law is unconstitutional, then that doesn't mean, oh, we're done, we cannot enforce this policy. That's not what it means. It means that the legislators must amend the language of the law, how it was written. You can still get your policy in effect, but you just have to change the language to make sure it's consistent with the Constitution. Okay, so somebody might strike down part of the Obamacare, and that doesn't mean, okay, it's gone. It's not what it means. It means the idea is, can we do a certain thing under any circumstances, or does the Constitution say no, or is it simply a language issue? Do we have to change the language? Congress passed legislation, the McCarran-Ferguson Act, okay? It states that regulation and taxation of the insurance industry is done predominantly by the states, okay? But that federal antitrust laws apply to insurance to the extent that the insurance industry is not regulated by the states. So that was a big law. So that lets people know, the insurance companies know, where state regulation, what it covers and what it doesn't. And if there's something, if there's an issue that comes up and it's not specifically covered by state regulation, it's going to be covered by federal regulation. Okay? That's important. It draws the boundaries. It just helps clarify. And there won't be nearly as many cases that are made to challenge interstate or regulation by the feds if people know, hey, there's been a precedent. If state regulation doesn't cover this, we know it's covered by the feds. There won't be nearly as many cases because it's settled. Do y'all not have that in your notes?
It's just worded.
It's, yeah,
Okay.
it's worded differently.
Okay. Are you caught up? Ready to go? All right. All right. Next big law, 50 years later, the Financial Modernization Act of 1999. Okay. Doesn't seem that long ago to me. Seems long ago to you. 20 years ago. All right. So, in 1929, after the crash, Glass-Steagall prevented banks, insurance companies, and investment firms from competing outside of their core area. Okay? The crash scared everybody. And they said, we need to keep these operations separate so that management will have the capability. You don't want investment people running insurance companies. You don't want insurance companies running investment companies. Okay? And how do we regulate firms that do all of these? It's much harder. So they said we're going to draw a boundary around each of them. Banks, insurance companies, and investment firms are separate. Okay? So in 1999, Glass-Steagall was thrown out. And it enabled consolidation to occur. So these firms could merge. And they have. Okay? So you have regulators for this, regulators for this, and regulators for this, and now they all merge. And you got to change your entire regime of regulation. Okay? So what do we have? We have state insurance departments that regulate the insurance operations. And in the banking area, you have state banking regulation and federal banking regulation, depending on what kind of charter a bank has, whether they're a state bank or a federal bank. And then you have the SEC that regulates the sale of securities, the investment firms. Okay? All right. And then you have the Federal Reserve, which controls the money supply and also has some regulatory authority in banking. Okay? So the Federal Reserve has some oversight if a bank is involved. If you have a holding company that owns all these things, the Federal Reserve is going to be involved too. So the message here is regulation has gotten very complicated for these companies that are merged. So you have to have people who work at the company who understand regulation. Okay, it's called compliance. Compliance. All right. And it's a big cost, folks. Compliance costs a lot of money. Okay, you've got to have full-time people, and they're going to spend a lot of time filling out reports and communicating with other people in the company about what they can and cannot do. And it's not an easy thing. All right. Next we have Dodd-Frank. Okay, and typically these reforms happen after a crisis. A crisis is what causes these reforms to happen. All right. Implemented in 2010, just like Glass-Steagall, implemented after 29. Okay? So there were some abuses, a lot of abuses going on, and they involved primarily the investment banks and insurance companies and banks, but primarily the insurance companies and the investment banks. All right. So two provisions of Dodd-Frank that affect the insurance industry was the creation of, one of them is the creation of the Financial Stability Oversight Council. Okay? And one thing they do is identify and treat systemic risk. What is systemic risk? Systemic risk is when the failure of a company could cause a domino effect in the economy. That's systemic risk. You've got one failure, one company that fails, and all of a sudden you've got a bunch of other companies that fail because of it. And that is a very scary thing. So identify the companies that are systemically important, and what do we do about it? Okay? How do we keep it from happening? Systemic failure. And then the creation of the FIO, Federal Insurance Office. Okay? So just another set of eyes looking at all these insurance companies. Okay? And again, it's looking at all the state laws and trying to find areas where state laws don't adequately cover issues. Okay? All right, and so this is the interaction. The FIO interacts with all the state commissions and represents the federal government in all of these conversations. They tell the state guys, if you're not going to cover this area, then we are. Then we are. Whoops, I want to do that. See why it's doing that, but we'll figure it out. All right.